Welcome back. The downgrading of the U.S. sovereign rating by rating agency Fitch continues to pull down risk assets for a second day, but today's fall in Asia and India is much more muted. Will markets completely ignore the Fitch blow in a few days, or will it continue to linger and keep a lid on equities and a floor on the dollar index? For these questions, I have with me Stephen Englander, the global head of GTED FX Research and North America Macro Strategy at Standard Chartered, joining us all the way from the US, and Hemant Mishr, co-founder and CIO of SCUBE Capital, joining us from Singapore. So we are covering both continents. Hemant, with your permission, let me start with Steve, since he's staying up for us. Steve, thanks very much. The bond market reacted very sharply to Fitch's downgrade, yields moving to 4.1. Now, would you say this can hold, or is it knee-jerk?
I think it's more knee-jerk than lasting. We haven't seen US CDS go up meaningfully. And, we haven't seen expectations of, Fed rate hikes go up. So this is pure risk premium. I think the market is trying to digest this, but I think that this fear won't hold over time because nothing that much has changed.
So what are your thoughts on the dollar index? The index moved higher to 102.6. That was about a 1% gain after the Fitch event. What are the chances that it strengthens more?
Well, I'd say it's a decent move. And, it's a move against the, it would be even more if not for the, for the yen sort of holding in there. But it's moved quite a bit against the euros, quite a bit against commodity currencies, reflecting the risk factor that I'm talking about. I think that the market really has to digest this, but I don't think it will hold against the dollar. I think you're going to need. I think the dollar will need something else to support it.
Okay, in that case, what's your trajectory for the dollar here on? Is the direction going below 100, or does it strengthen from here on?
I think that the dollar is going to fall back. It may take a while, and obviously there's a big risk factor here because of the, because of payrolls coming out on Friday. But I think that if payrolls surprise to the downside, I think that some of this fear will be reduced. And, it's just, for example, it's not as if the AAA countries saw their yields go down. So I think, again, anything can happen, but I think that this looks so much like risk premium out of nowhere. And I think there's a tendency for that to erode over time once the market, digests the full impact, which should be small.
Okay, so your short point is Fitch will be forgotten as other data come in.
I think so. Obviously, say payrolls come out at 300,000. Our forecast is 175. But say it surprises and comes out really on the strong side. We could get a continuation. But assuming that, payrolls are kind of in the range that the market expects, I think that the dollar isn't going to keep these levels.
Okay. Yeah. Okay. So I get that. What might keep the dollar strong could be a strong U.S. economy macro, but not because of the Fitch event. Hemant, you've been listening to what Steve is saying. What is your sense? Also, just a 1 day or a 2 day heart attack?
So I tend to agree with everything that Steve said. So the reaction, in some ways, Latha, has been very muted. Not surprisingly, though. But I'm drawing an analogy with what happened in 2011 when S&P did something similar. You had the Treasury sell off at that point in time by around 25 odd basis point. This time, the way the markets have reacted, you've seen the curve steepen, the long end steepening more than the shorter end, and there are no prizes for guessing that. But it's only 8 to 9 basis points. So in some ways, what Fitch has effectively communicated and conveyed is something that's known. The US debt as a percentage of GDP is untenable at this point in time. Fiscal deficits going very, very high. But ironically, immediately after Fitch made announced their decision, you had while the yield curve steepened, you saw the dollar actually going higher. So in some ways, the safe haven bid, at least for the time being, is supporting the US dollar.
Yeah, that's what. Normally, when other sovereigns are downgraded, the currency falls. The dollar obviously behaves differently because of the safe haven, as you're saying. Well, actually, Steve, just one last question to you about Fitch and its impact. We saw this huge fall in risk assets, equities. But of course, that's coming after the big rally in March. Now, does that rally resume, the the equity rally?
I think that it was hard to explain why the market was going up. I think this is the wrong reason for it to go down, but I think, going down a bit is probably healthy.
Okay. So you're expecting it to go down, but that's not for the Fitch reason. What's your sense, Hemant? You watch the equity and the risk space also very closely. We have seen this extraordinary rally and US GDP numbers and even global GDP numbers actually getting revised higher. Do you think the risk rally has legs?
Other than the tactical impact of Fitch, I think, yes, it has strong legs. The US economy has been a lot more resilient than anybody discounted, investors and even Jerome Powell. And I think that will continue. So our base case scenario, Latha, is of a soft landing. We don't see a recession, and which is where we differ with Fitch, who their estimates is expecting a recession. So equity rally in some ways has legs. But on a relative basis, fixed income looks a lot better, given where rates are, not just in the US, but rest of the world. I mean, you can invest in a AA paper and get, on an unlevered basis, 8.5%, 9%. I think the important bit for us is the Fitch action has more impact on credit than on equity markets. And they're not just talking about the debt ceiling and the fact that there was a last-minute conversations and that's how it got resolved. They're actually highlighting medium-term issues on a decelerating federal revenue line, while at the same time, Medicare bills will go through the roof, Social Security expenses continue to go higher. In fact, the Social Security fund might just be completely depleted by 2033. And these are very important issues that the Fitch has raised and need fixing. I think for me, the important bit is there's only one rating agency that now rates the US as AAA, Moody's. And it's important to see what they do going ahead. And God forbid, but if they were to act and follow line with S&P and Fitch, I think investors will have to take a serious look.
Okay, so are you saying that Fitch was anyway telling us some home truths, which we probably already know, and therefore this can result in generally an economic problem for the US, and therefore you would question the rally down the line?
No, I'm not saying that. I'm saying the rating agencies, for whatever their inputs are worth, they look at the same data set. A lot of the data set is, I'm sure it's a mix of quantitative data set and qualitative data set. A lot of the data set is in the public domain that investors like ourselves, and I'm sure Steve and his team are looking at. Now, with two of the investors having acted, and at least Fitch in their case, the rating rationale seems to be talking of medium-term structural issues that the US needs to fix in terms of its spending. And if it can't curtail its spending, then clearly it'll have to look at tax-related hikes and whatnot. Now, all of this will crowd out investments. And in some ways, it's a concern that investors will now have at the back of their mind. I don't see an immediate impact, but the US hasn't got the luxury of not fixing its medium-term fiscal issues. As you rightly mentioned, if it were any other country, it would have been rated differently. And let me give you two data points. The US fiscal deficit is going to go from 3.7% to around 6.5%. In the next 3 years. Now that's substantially higher than any AAA rated company, or for that matter, even a AA rated company. Their interest to revenue number is 10%. Now guess what? For other AAA countries like Singapore and Switzerland, it's actually 1%. So one can well build a case that a AA plus was the right rating for a long period of time. and might continue for a period of time unless they fix some of the fiscal challenges that the US has, which have long been known but have not been acted upon.
Okay, I'm coming back to you now on the credit market, but let me, since I've been holding on to Stephen very late in the night. Steve, you know, in the medium term, how do you see the US economy, considering what Hemant is saying? Do you see a sharp slowdown, and hence how will equities and debt markets, for that matter, move medium term?
We see a recession, a small recession. And so we think that we think that's actually going to be positive for risk assets because it's going to lower the discount rate for asset pricing. So we think, you know, it's probably going to be supportive both for US assets, but also for global assets and for carry trades.
Okay, so now to come back to you, Hemant, you're speaking about a difficult US situation in terms of the fiscal deficit and the debt that they will have to service and raise. So where do you see yields? Do you think the US yields don't go down that much, which means global cost of capital is going to remain high?
Is that for me, Latha?
Yes, for you, Hemant.
Wonderful. Yeah. So I find it at odds that 30-year US paper should be at 4.1 for the fiscal imbalances that they've got over the next few years. So does this necessarily mean that global cost of capital goes higher? No, for the simple reason that the US does benefit for a host of reasons. One is obviously it's a very dynamic and resilient economy. And they have, I remember 10 years ago, we used to talk about the US twin deficit problem, the current account deficit and the fiscal deficit, and they successfully navigated both of them. So they've always come back from a difficult situation and fixed it. So the hope is they'll do it again. The second bit is the benefit of a reserve currency, you know, which the world will want to invest in, and there is no alternative. So you know, even if investors would want to diversify their risk, they can't. Third bit is the safe haven bit of the US Treasuries, which is the only risk-free benchmark currently. That you know, credit markets, equity markets, the
so basically, my point is, will yields fall for an Indian investor and an Indian business? That becomes important willy-nilly. You see US yields falling back. Yeah.
So I do see that when the monetary stance of the US will change, and you know, I mean, our view is we are at the terminal stage of the US rate hike, potentially under 25, but after that a fairly long pause and then a rate cut. And the yield curves are discounting some bit of it, but I'd like to believe the near end of the yield curve will further come off. I'm not sure the long end will come off. The long end will remain tight. There's good reason why it should be at 4.1%. The 30-year US Treasury yield should be at 4.1% and beyond. So you'll see the yield curve steepen more.
Okay. Got that. So you see near-term yields fall, but not long-term yields. Well, we are out of time, but interesting discussion. Steve Englander, thank you very much for staying up. Hemant Mishr, thank you very much for giving us your perspective on the Fitch downgrade and the medium-term issue, which is not looking all that bad. Wrap up on Bazaar on that note. Chartbusters up next.